Hey everyone, thanks for joining me for this one. We potentially have the craziest weeks of earnings coming up this week of the entire year in the stock market. You're looking at the screen right now, you can see all the names reporting this week. In this video, I just really want to go day by day and talk about what companies I'm going to be looking at and what I'm going to be looking for within their reports. We're going to look at what their earnings per share estimates are, if I think these stocks are fairly valued, overvalued. Would love to hear from you guys in the comments. If you disagree with any of my thoughts or have any of your own opinions, be sure to drop it down below. Also, if you like this type of content, be sure to give the video a thumbs up. It really does help with the YouTube algorithm. But we're just going to start here on Monday. So Monday, in the grand scheme of things, a bit of a slow day, but it's a couple names I'm pretty interested in. The first one is Domino's. Domino's is a stock that plays in the restaurant space, obviously, quick service restaurant, big global presence. They were going up and up and up, and they recently had a bit of volatility, but have recovered nicely. We'll go into that one a bit. And then Whirlpool, who got hit really hard this year as interest rates went up, new housing starts were feared to be going down, and they get lots of their business from that. Also, lots of people may not be dishing out that kind of money to re-up their appliances. So we're going to take a look at that stock as well. So going into my couple key stocks for Monday's earnings. So Domino's here, $385 a share. Looking at this one long term, you can see it went all the way up over $500 during the pandemic. It was running at a very high price to earnings ratio. What's interesting about Domino's is their market cap is not that big for how global a company this is, under $14 billion, partially because they are pretty much entirely franchised. So this is not all of the economics that they're capturing under the Domino's brand. It's lots of franchisees making lots of money that is not included in the company, which may be why, if you're not familiar with that business model, why you may be surprised to see the company's only worth $13 billion. So they do pay a dividend, 1.2%. Looking at just kind of the ride they've gone on, they went all the way down to, this is in the last year, I think is a better read here. Went all the way down to 290, give or take dollars. I think it has it here, 52-week low at 285, and has recovered extremely nicely, up about 35% from there. So pretty crazy just to see how fast this stock has bounced back. It tends to be a very good performer. So it's really interesting to see just how little amount of time it spent there at 280s or in the 200s. Looking at their earnings per share estimates, they're expected to do about $13.50 this year and then $15 next year. So on the $15, they're trading right at around 25 times, give or take, which is pretty standard for like a best-in-class quick service restaurant franchise licensing model where it's very asset light. So depending on same-store sales growth and whatnot, this one may lag or do outperform tomorrow, but their going-in valuation seems maybe a bit on the high side because that's future-looking earnings of 2024, but definitely fairly valued, too, if anything, on the high side going in. So it's not one that I'm overly interested in, but I do own McDonald's. I do own Restaurant Brands International, some other food businesses. So I will definitely be watching to see what Domino's puts up tomorrow. The second stock that we're talking about there was Whirlpool. So Whirlpool here has bounced a bit. If we look at them from the low, they were in the 120s there. Have made a bit of a recovery. Maybe the sentiment around U.S. housing's bounced up a bit, up 20%. This one's still giving you a 4.7% starting yield to get in on Whirlpool. So they're still at a pretty decent valuation. If I look at their earnings, they're going to do over $16 or about $16 this year. And then they're actually estimating to grow 10% next year. So this company's expected to have a price to earnings ratio of under 10 with growing double digits on earnings. So if their forecast actually comes true, this could be a really good buying opportunity to consider. You're going to get 5% a year to wait for the story to play out. And then if they actually make $17, $18 a share, have a hard time believing a company like Whirlpool is going to be trading at 8 times earnings or something like that. If we just take a look at their annual revenues over the last 5 years or so, 21 billion, 20 and a half, 19 and a half, 22 billion, 19.7. So a bit of volatility that they experience on this business, a bit of cyclicality probably, and also they've also had some years of having a gap decline. So maybe some factors that I'm not aware of in terms of the longer term and how this company does over a multi-year stand. But today, just looking at the price to earnings and where the company's trading at, the dividend they're committed to looks like a potentially interesting opportunity. So on this one, I will be looking at earnings as well. Going into Tuesday, so Tuesday has a lot of interesting names. We got Verizon. I own AT&T, so I'm going to be really interested in what Verizon posts. Microsoft, they have so much to talk about. We'll get into that in a few minutes. Visa as well. There's a lot of other names here. Maybe we'll take a quick peek at Alphabet. I'm not sure I put it on my list, but I do own that stock as well. Just so many stocks on Tuesday. Maybe the best day of earnings in terms of the amount of companies reporting between Tuesday and Wednesday. Definitely a lot going on. So we're going to start off with Visa. Visa is a great company. Love this business. I do own shares of Visa. I actually did a video in January when Visa was just over 200, saying how I'm buying Visa this year. I think it at the time was worth about $245, and now we're pretty much all the way up there. So I've slowed down on adding this one, but I still think it's a great business to own. Looking at their valuation here, $9 per share this year. So trading at about 27 times this year's earnings, closer to $10 next year. So on next year's earnings, 977 to be exact. So we're trading about 25 times next year's earnings. So, if you were to ask me, would I rather pay 25 times next year's earnings on Visa or on Domino's? For me, it's a pretty easy answer. I think Visa just has a lot of category and industry tailwinds around cash to card, and also just economic growth in general, especially in emerging markets. So I love Visa stock. I think it's a great business. Just interested to see what numbers they post up if the stock goes down and the fundamentals still seem in place. Probably one that I consider putting back on my immediate buy list. Going into the second stop, Microsoft. So Microsoft's been on a bit of a crazy ride too. It doesn't look like it by the chart, but they did dip to 220, and if I go on the long term, they were at about 340 before that. So they had a pretty meaningful 35% drop or so on the business. Microsoft has so much that they're going to talk about on this call. They're going to talk about their new AI product that they're trying to roll out among their Office suite. They announced that they're going to be looking at charging an extra $30 a month for that service. So it'll be really interesting to hear them expand and elaborate on that a bit. They also have the Activision Blizzard deal that looks like it's going to go through, but they extended it to October just to negotiate with UK regulators. So it'll be really interesting to see how much they comment or, decide not to comment on that. But some really big things going on strategically on the Microsoft business. And the market's given them the benefit of the doubt, especially if I just look, let's call it last 6 months. For a $2.5 trillion company to be up 40% in a 6-month period is insane. That's like over an extra $1 trillion of market cap that this company's value has gone up just in half a year for a company that's been around, for decades and decades. It took them to build that first trillion, and then in just 6 months pop, they get another trillion. So I'm being careful with this one in terms of an entry point. It looks like it did dip a bit here, just 4 or 5% probably from the top there. Yeah, 4.5. But as a existing Microsoft shareholder, really looking forward to what they talk about on the call. And I'm not too fussed about where the stock goes after hours. If it goes up, great, I'll continue to hold. If it goes down, I'll evaluate potentially entering into more shares of this one. And then just looking at their price to earnings here, looks like current year they're under 10 on the earnings side. So it looks like they're trading about 36 times. Next year, they're going to be trading around 31, 32 times. So yeah, definitely an expensive company, but one of the best companies from a quality standpoint in the market. And then Verizon. Verizon's going to give me a bit of an early look and feel of what AT&T may look like the next day. These companies have gotten hammered. Wall Street Journal published an article or whatnot about toxic lead exposure in big telecom networks. So that really pumped down these stocks a lot. In addition to that, they just still have a ton of debt. They're dealing with the demise of cable, like lots of headwinds going on for these stocks. But the reason I own AT&T is just I feel like the net present value of their cash flows are still worth something. And if Verizon's able to deliver around $5 of EPS, they're trading at under 7 times earnings. So you're getting like a 15% return on your investment that they can give you in dividends, and they are giving a 7.7% dividend here. And then the other half, hopefully repaying debt, investing in new growth levers on the business. I just think the equity is priced pretty cheaply in the grand scheme of things on these telco companies. So I think that's all I got on Tuesday. I'm just going to take a quick look at Google here. Google, also known as Alphabet, at about $120. This one hasn't, run to the same extent as Microsoft, just because Microsoft's coming in on their turf a bit here. But they have, rebounded from the lows for sure. On Google, trading at 27 times, trailing. I think they're more mid to low 20s on forward looking. So Google's one that I'm not investing in right now. I'm focusing more on my dividend stocks and stuff like that. And I really want to see how all the AI stuff plays out between Google, Microsoft, all these other companies. But definitely one that probably is fairly valued, generally speaking. Okay, back to the stock chart. On Wednesday, another crazy day. Lots of companies I own are actually reporting on this day. Some that I'm just interested in. AT&T, I was just mentioning as part of the Verizon conversation. Really excited to see their earnings, more so what they talk about. They've had some free cash flow issues the first half of the year, so we'll see if that settles down now that we're in the back half. Coca-Cola is one that I've been buying aggressively over the last handful of months, so interested to see what they report. Meta, I'm a bit worried for Meta's report, to be honest. Just from how much my Meta position has gone up in the last few months, could just crater down, I feel like, depending on what they talk about. And then the last one is Chipotle. Similar to Domino's, I do not own Chipotle, but I just have a lot of exposure in that space, so love to just get a better understanding of what's going on. So we're gonna kick it off on AT&T. Super similar story to Verizon here. $100 billion market cap, paying a 7.5% dividend, down 20% on the year. But if I was to look at it, at $105 billion market cap, they're expected to do $16 billion in cash flow this year. Now, part of the reason the stock's down, in addition to the same reasons I was talking about on Verizon, is in the first quarter, I think they delivered like $1 billion. So the street is concerned they're not actually going to be able to deliver $16 billion in 2023. We'll get a good read on this quarter on if it's possible. If they post up like a $5-6 billion free cash flow number, I think the stock will pop on earnings. But if they continue to struggle, just a couple billion in free cash flow, it may even raise more questions on their ability to hit strong free cash flow numbers and pay that dividend plus reinvest in the business, etc. From an EPS standpoint, they're going to do about $2.50. So looking at their earnings here, their stock price rather, the equity's trading at about 6 times price to earnings. So same sentiment. I get it. These companies are in growth mode. They have a lot of headwinds. At some point, though, they still have value. And I think it's undervalued at these levels. That's why I have an AT&T position in my portfolio. Moving on to Meta. So Meta makes me nervous just when I look at this chart, up over 75% in the last year. If I go year to date, we're up almost 140%. So just an absolute crazy run here, currently valued at over $750 billion. If I look at earnings for this year, the company is trading they're doing $12 of EPS this year, so they're trading, give or take, 25 times. Next year they're going to do closer to $15, which means they're about 20 times next year's earnings. Fair multiple, assuming they continue to right size their investments in Reality Labs. Maybe they start getting some more traction there. Their user numbers and their KPIs continue to perform well. I can see how they can continue to do well from a stock price perspective with that valuation going in. There's just a lot of risks here as well, and lots of investors may just want to dump the story if they just got to double up on the stock. So we'll see how that one goes on Wednesday. On to Coca-Cola. Coca-Cola, these companies I feel like don't fluctuate a whole heck of a lot because of the nature of their business. But this is one that I've recently been buying over the last couple of months. I've added 150 shares to my portfolio. If you want to see my portfolio, you can see it on the channel. I just did a full in-depth portfolio review of every single position I own in my Wealthsimple account. But I have 150 shares of Coca-Cola, averaged about $60. You can kind of see here it's gone between, since I started buying in, between $58 and $63 for the most part is where Coke's lived, paying a 3% starting yield. We'll be interested to just learn more about this company since it's a relatively new position for me. I don't think if the stock goes up, I'm going to sell or anything. I'm in this one for the long run. I've built out my initial position. But if it goes down, maybe it's one I put on my watch list to continue maybe adding up to $200, depending on if I still like the earnings with the lower price. Going into their EPS, going to do about $2.60 this year. So trading at about 24 times this year's earnings, and then closer to 22.5, 23 times next year's earnings. Let's call it 2022 next year's earnings at over $2.80 a share. So I think fairly valued, not a steal by any means. It's low risk, low reward on this one, but I like the 3% starting yield. I like the increase in dividend every year over the last 50 years. I think I'll do well long term on it, but I don't think it's going to double up like some of these higher risk reward ones over here with Whirlpool trading at 8 times next year's earnings or something like that. Going into the next stock on Wednesday, it is Chipotle. So Chipotle is one of the best performing, or probably the best performing restaurant stock in the market, up 400% in the last 5 years. Year to date, up 50%. Last year, up 60%. $58 billion company we're talking about here. This is a massive company, and they actually own all of their retail stores, I believe. So unlike Domino's, where you saw that lower valuation, Chipotle owns their entire end-to-end chain of businesses here. They're going to do about $45 this year. Should have gotten a calculator. But if they were doing $50 a share, it would be about 42 times earnings. So about 10-15% less than that. The stock's trading at about 60 times current earnings. And then for next year, they're trading in the high 30s. I think it's a great business. This is tons of momentum, great business. With interest rates as high as they are, I just cannot justify buying a restaurant stock for 40 times earnings. So congrats to everyone who's gone along for this ride and got in this game this year and previous years when we're looking farther out. This is one that, while I acknowledge it's a great business, is just way too expensive in terms of a price to earnings ratio for me to be interested in buying it. So I'm expecting them to have a phenomenal quarter, trading at 60 times earnings. They better have a phenomenal quarter. If they don't have a phenomenal quarter, this is one that could probably revalue a bit to the downside. Okay, going into, I was going to go into Thursday, but I have one more on Wednesday that I forgot. I wanted to just touch on Mattel. They've had a big rip lately, up 17% in the last month, behind lots of hype on the Barbie movie that just came out that's paired with one of their brand. Free marketing. Lots of people may go out and buy Barbie. The Barbie brand is probably more valuable than it has been in a long time now. So it'd be really interesting to see the impact that movie has on their business. In addition to that, they may be getting, I think they get like some sort of royalty or revenue stream from the movie sales itself. So for a company that's only at $7.5 billion market cap, that could actually move the needle. So I kind of understand this jump here. I think it was one of the best performing opening weekends on that movie out of any movie in the last year since post COVID. So lots of potential for that to be like a trade of some kind. I'm not going to touch it, but I just wanted to flag it because some of you may be interested in it. Just looking at Mattel's core business here, they're going to do about $1.10, $1.20 EPS next year, about $1.50. So looking at their stock chart here, they're trading in a high teens price to earnings multiple, expected to be a low teens forward price to earnings multiple for 2024. For a company like that, just looking at their stock chart here over the long run, lots of volatility. Oh my gosh, tons of volatility. That's probably a directionally fair area for them to play in the mid-teens for a toy company, but a really well-distinguished toy company at that. Not one that I'm interested in getting into. I just think it may be an interesting trade for some people watching who may want to do some more research on that one. Okay, going over to Thursday. Tons going on in the market on Thursday. And on Wednesday, just to call it out, it's some that I'm not looking at. We have Union Pacific, eBay. Wyndham's actually another one that I'm looking at, so I'll circle back to that. But other hotel chains like Hilton, Tilray's marijuana company, Boeing, tons of great earnings reports depending on what your portfolios look like, what interests you, what you'd like to see and watch. Like tons of material out there. So yeah, definitely not a bad day to book a couple hours off to go through or listen to some earnings reports after work. I'm gonna close off on Wyndham for Wednesday before touching on Thursday here. Wyndham is a stock that, similar to lots of those franchisee restaurant businesses, has a very asset-light model. They just franchise their brands to operators who then pay them a royalty off the top. So money coming in, I think they have $400-500 million of money coming in, and almost all of it goes directly to the bottom line. They use that money to buy back shares every quarter, create new brands to get new hotel room growth, and then also, strategic financing, stuff like that. But overall, they've done a really good job returning value to shareholders. They've decreased their share count from 95 million to 80 million just in the last 5 years. And their overall stock performance has gone up as well. They pay a nice dividend that they tend to touch as the business performs well. So I've always liked this company. I've bought in and out of it a couple times. I've never really got the opportunity to pick up a big position because as I look at every time I bought this stock, it's jumped between like 6 and 10% in the days following. So I've never gotten the chance to really build out a position at a price that I like. But looking at their earnings here, it looks like analysts have taken up guidance, and that may be part of the reason why the stock's been ripping a bit lately. It used to be doing $3.50 on the year. Now it's up to $4 on the year, and next year's at $4.30. So at $4 on the year, this one's trading under 20 times earnings, even though they're pressing up closer to their 52-week high here at around $75. So, for me, this one is a bit too volatile of a business model and relying on average daily rates across these hotel chains that could go down just like a snap, right? It's not like rent, like a residential REIT where rents are locked in. These room bookings can go away, people can cancel, rates can go down, things can change really quickly. So have trading still at like a 18-19 price to earnings is still on the high side for me for a company like this. Would love to get it closer to 15 times. And it gets there. I've bought in at 15 times a couple times before it's went up to 17 times on price, and that's when I've dumped it just because I didn't have a big enough position to hold through. But yeah, great business model, just a bit too pricey for me at these levels. On Thursday, we have McDonald's. That's one of the companies that I own, so I'll be really interested in that. But we have a lot of travel stocks too that I'm not going to talk about today, but Southwest, really important travel stock. Royal Caribbean, another one there that many of you may be interested in. We got Ford reporting, Intel on chips, Roku, if you're really into streaming and the broader landscape there. Crocs, I know lots of retail investors hold. MasterCard, I'm already going to know what Visa did, so I won't be too interested, but some of you may hold MasterCard instead of Visa. Honeywell, Bristol Myers, AbbVie, T-Mobile. So lots going on the Thursday. Personally, for me, I'm going to be focusing on McDonald's earnings. This is another one in my portfolio, similar to Meta, Microsoft, that I see a ton of risk, unfortunately. It's a pretty big position for me, but I've held it for so long. I'm not going to sell it just because I think it's overvalued this point in time. But this stock has done phenomenally, up 90% in the last 5 years, up 20% in the last year. We're trading at a 2% starting dividend yield. If I look at the earnings per share estimates, it's at $11 for this year, which means we're trading at 26 times current year earnings, $12 for next year. So we're trading, 24 times next year's earnings for a restaurant company. I think it's a bit rich, especially the 26 to 27 times current year earnings. So I think there is some risk if they don't hit same store sales growth and whatnot, that this one can get a bit of a dip, which I don't mind. This is definitely one of my long-term holds. If it goes up or if it goes down, I'll continue to hold it. But definitely one of the ones I'm a bit more nervous for, let's say, this week. And then pivoting to Friday, some other interesting stocks here. Oil stocks, for those who are interested, we got ExxonMobil, Chevron there, AstraZeneca, so a pharma company there, Colgate and P&G for CPG. So it'd be really interesting to contrast those two companies. Personally, I have P&G in my portfolio. So looking at P&G stock quick, holding up pretty well. If you look at it longer term, it did dip into the high 130s, around 140s earlier this year, but currently sitting back at 152, close to the top of their 52-week range. When I look at their earnings per share, let's call it $6. So $6 is about 25 times, 26 times, because they weren't really $6, 26 times current year, and then next year they're going to grow 4 or 5%, so it'll be 24 to 25 times next year's. I have similar thoughts on McDonald's. It's with this one, great business, and all probably trading on the higher end of the range that they should be, but we'll see what kind of numbers they put up. We'll see how their competitors also do. Starting on Friday and into next week. So this is an interesting one to watch. You had a 2.5% starting dividend yield, and similar rhetoric to my comments on Coca-Cola. They increase their dividend every year. So you had a good starting yield, and then hopefully it just goes up from there every single year for the rest of your investing career. So that's that. Tons of earnings happening throughout the week. Lots that I didn't even touch on today. We have Spotify here, Philips, et cetera, et cetera. I kind of called out some other ones like Boeing, Ford, Bristol Myers, but didn't go into it in any level of depth. Let me know in the comments if you like this type of content and what earnings reports you're looking forward to this week. Not too many people make it to the end of the video, so if you did, please let me know in the comments as well. Would love to chat with you guys. Also, give me a big thumbs up. It really does help with the YouTube algorithm, especially for smaller channels like myself. Thank you guys for watching this one, and I'll see you guys in the next one.